Hello everyone and welcome to this lecture on event study analysis. So in this lecture we will discuss about what is an event and what we mean by the event study and how we can conduct an event study analysis. Then the various aspects of the event study analysis. So this event study analysis is basically a statistical method or tool which used to assess the impact of a specific identifiable event on the financial variable related to a particular firm or asset. So in general, if we wanted to assess the impact of any event which we can identify or quantify, so what is its impact on the financial variable of any firm or any asset. However, in general, it has been observed that we wanted to measure the effect on the asset prices. Though it's not limited, we could assess the impact on the volatility, on the other aspect. However, it has been uh, widely used to assess the impact of an event on the asset prices. For example, the corporate actions. So that could be merger or acquisition or stock splits or the dividends. So here the event, it could be any event, it could be related with the particular firm or it could be regulatory changes, for example corporate tax rate cut or announcement some quantitative measures or support, or the macroeconomic announcement, for example monetary policy decisions, all those, or even the political events, for example say the election results or some policy announcements or the agreement with some other countries. So any event which could be identified, so those event how it is going to affect the financial measures or financial variables related to a particular firm or an asset. So that's what we do in event study analysis. For example, if we see here, so here I have plotted the evolution of the BSE 100 index, which is basically a broader index of representing the Bombay Stock Exchange, and it is a overall measure of the market performance. So here we have plot that the time series or the over there how it has evolved, and these are the different markers. These are the red lines are the markers of the different events which has occurred. For example, let us say the demonetization in 2016, it has happened here. Then here we can see there is the jump, there is the fluctuation. So does that this demonetization has effect? If it is, then how it has been? Similarly, for example, the announcement of the corporate tax cut. So here we can see the jump is from here to here. So what impact it has? Similarly, others we can see, for example, the COVID lockdown announcement or the HDFC merger here or the earning announcement by the TCS. So these are the various events that happen and how it has affected the BSE 100, that is the price of the BSE 100, or we can say overall market performance. Similarly, if we can see here, for example, a particular company, if you take firm, for example, Reliance Industries. So this is the stock prices of the Reliance Industry. So what we can say, it represents the valuation of a particular firm. So they announced that they will make an investment in the new company named Jio. So we can see here there is the fluctuation in this case here. So what is the impact of that we have? So if you wanted to know or if you wanted to quantify that, so that's nothing but the part of the event study analysis. Or we can think of the TCS. So here when they have announced the earning, then what happened here? So those are the certain fluctuations we can observe here. Or similarly, we can see the HDFC case when they announced the merger, so how it has impacted their stock prices. So these are the some of the event, and we can observe the certain reactions of the individual stock prices or the overall market. And if you wanted to quantify those, we wanted to see the quantity measure the response, then uh, we have to resort to the event study analysis. And the underlying assumption or the rationale for this event study comes from the theory of efficient market hypothesis, which already we have discussed in this particular course. So we know that, you may recall that in the efficient market hypothesis, what we assume that these asset prices of any asset reflects the all available information. So if there is the PT is the price at time t, that means it reflects all the information available at up to time t. Now, if any event occurred, that means that information is public now, then the price should observe or reflect that particular information here. So that means this market process processes the information about that event in an efficient and unbiased manner, or it can quickly absorb that and it should be get reflected into the price. So the basic idea here is that through the event study analysis, we wanted to examine that is the market efficiently has absorbed that price, absorbed that information into the price. Is it the price reflects the information, new information which has come in form of an event. So in that sense, we can say that event study analysis is a test for the market efficiency. So basically, it tests the weak form of the market efficiency. That is basically it tests the semi-strong form of the market efficiency, which states that prices adjust immediately to the new public information. So if that is the case, that means this price T should have all the new information incorporated into this. If that is the case, then there should not be abnormal return. What is the abnormal return? So in simple terms, we can say uh, it is the difference between the actual return and the expected return. Expected return here basically is, we can say, the average return. So the difference between this, if that return is not equal to 0, that means there is the abnormality into the return. And if the market is efficient, that means that information has been captured by the prices, and that then there should not be any abnormal return. So in that sense, we can say the event study analysis is also a test of the market efficiency. Now, the event could be controlled by the firm, or we can say an event could be within the control of the firm's control, or it could be outside of the firm's control. For example, stock split announcement, earning announcement, or the dividend announcement, mergers or acquisitions, these are the within the preview of the control of the firm. However, for example, macroeconomic policies or the announcement of monetary policy or tax cut rates, all those are the out of preview of the control of the firm. So event could be outside of the control of the firm or within the control of the firm. However, both these event could have impact on the asset prices. In the literature over the years, it has been observed most of the studies has been focused on the mergers and acquisitions or earning announcement or the issue or debt and equity or the IPOs, initial public offerings, or some of the macroeconomic policies, for example, monetary policy or the tax rate cuts, or even some political announcement, for example, election results. There have been certain studies which has has conducted this kind of event analysis in literature. Now, what are the certain steps we follow in the event study? So we can say the estimation of the abnormal and the normal return. So basically, before that we could have the identification of the events, then the selection of the sample of the firms, then the estimation of normal and abnormal return, what estimation procedure we should follow, then the testing procedure, and finally getting the empirical results and interpreting those results. So these are the certain steps we can take to formulate an event study. Now, first let us understand about the event study timeline. So event study timeline, we can see what are the time frame we take to conduct this event study analysis. First thing, to identify the event day, the exact time or date when the event has occurred, when event has took place. So that's, let us call it here in the timeline as a 0, that is t is equal to 0 we are taking here. So at this certain point the event has occurred, so that in general we represent it as a t0. Now if we observe here from t1 to t3, what we call the observation period. So in that period we try to observe the phenomena or changes or the dynamics of the price which could be related to that particular event. So what we call the observation period. So during this period we can see what is happening with the changes with the price. Now the one question arises, okay, after the T0, that is, let us say from T0 to T3, it is what we can say from this point to this point, it is intuitive to understand, okay, this is the observation period. Now why the from 0 to -2, that is from this period, why it should be treated as the observation period? So basically this comes in the fact that sometime the people may guess or some people may have the knowledge of the certain event. For example, if a particular company going to acquire some company, or it is going to merge with some other company, or the company may split the stock. So sometime those informations could be available with some people, and that reaction may observe into the prices. In some cases what we call the insider trading, or sometime let us see the political event, for example election of result declaration of election. So often we have the prior knowledge when the election result will be declared, and after the election there is a lot of exit polls happens, and through that people can guess who could win, and accordingly they can react, or accordingly the prices of certain firms or companies of asset could be changed. So for that reason we have included, that is the certain duration prior to the event as into the part of observation period. So if we find this is there the significant change, then we could relate it to there is the might be the insider trading, or might be the depending on the which kind of event we are considering in the event study analysis. So for example, if it is stock split, so it should not be into the public. So if that is in the public or some people know, then we will say there is might be the case of insider trading. Then next comes this T1 to T2. So this period, what we call this period? We call this period as the event window. So where basically the effect of the event, or we can say this whole process should be termed as that event has occurred. And in this specific case here we have assumed only one event, so the event is, there is the certain cases where there could be a multiple event. So the event could start from here and it could end up to here. So if that is the case, then we will assume that as a event window. So how much up to from where to which point we are assuming that event might have occurred. So that is the event window we have. Then this T5 to T4 is known as the estimation period. You may recall that we have discussed the concept of abnormal return, which was the difference between the actual return and expected return, which could be an long-term average return. So that means to find out the abnormality in this area, we have to have a yardstick, and from there we can measure, okay, there is the change in the dynamics of the prices, or there is a change in the return. To say that, to measure that, we have to have the yardstick, and to have the yardstick we have to have some kind of expected return. How to get that expected return? So we select a window which is not contaminated with by the event, and for that particular window we calculate the return, and that return is assumed as the expected return. That is the normal return we treat without the effect of the particular event. And from that, how much this return has been fluctuated, that we treat as the abnormal. So that period which we use to calculate the expected return or to find out the normal return, so that period is known as the estimation period. So here we have certain gap of this between the observation or the event window and the estimation period. However, in some cases we may start from here itself to treat it as the estimation period, but often we do have some gap between the estimation period and the observation period. Then this T2, that is from this part to this part, we assume as a post event window. Remember, from here to here, this here we are assuming as the event window, and from here, then from this point to this point we are assuming as the post event window. So that's the what we have event study timeline. So basically bifurcating that which part we should use as a for the estimation of the normal return, and which part should be treated as the event window and which should be treated as the post event window. So to bifurcate, to have that scheme, what we call the event study timeline. Now the first thing, what is event window? So basically horizon of, and in other terminology it is also known as the horizon of the event study, or in we also call it event window. So basically event study can be categorized by on the horizon. Horizon basically what is the duration we take for the event window. So short horizon usually from 1 month before the event to 1 month after the event, the maximum. So if we have the event at T0, so we can go up to 1 month here, that is the post event window after the event, and 1 month prior to the event. So the maximum is limit this, otherwise it could be 2 days here, 2 days here, so it could be -2 plus 2, or it could be -10 days and plus 10 days. So just after the 10 days of the event and before the 10. So this is known as the horizon. So this is known as the short horizon if the maximum event window is ±1 month. However, if it is more than 1 and maximum up to 5 years, then what we call the long horizon. So based on that, we have the two kind of event study window: event study, short event study, short horizon event study, and the long horizon event study. We will see that there is the certain, later we can see based on this how we calculate the normal return. That could be a different method to be calculated for the short horizon event study or the long horizon event study. And both these we have the different purpose. Usually the short horizon studies is being used to see whether the information disseminated to the prices quickly or not. Wherein the long horizon studies, we examine whether there is the market inefficiency are there, what are the reasons for abnormal returns we have. However, usually the short horizon studies has been conducted in the literature. So the first part in the event study is that we have to define what is event, and we have to identify that event. And the second part is the first step is we have to see the frequency of the event study, and third part of the first step is the sample selection. So when we define an event, so we are concerned about what is an event. Is it a political event? Is it the economic event? Is it within the firm's control, or is it outside of the control? And we have to find out the exact date. Uh, once when the exact date when the event occur. So basically three aspects we have to do when we say definition of event. Then the second part is the frequency of the event study. So how fast information is incorporated into the price. That means what is the period of the price we are taking. What is the frequency of the asset prices we are taking. Is it daily? Is it intraday? Or is it weekly or monthly? So another question comes, which price we should choose, which frequency we should choose. So there are the two things we have to remember. So first, if you are taking too long, let us say yearly if you are taking, so then it is too long to capture the effect. So it will be a misleading interpretation, because information cannot will take that much time to get integrated into the price. On the other hand, if you are taking, let us say, intraday data, then obviously there could be a lot of noise in the data. There could be a case of the macro structure. So then also it will be again some kind of misleading inference we can get. So either the long frequency of the lower frequency, or it is the intraday, both have its own limitation. In the literature, it has been suggested that usually this daily, weekly or monthly returns are the best. Among these three, the people have suggested that daily is the best way to capture the event study uh, or to conduct the event study analysis. Then the sample selection. So there could be the various sectors, or there could be various companies which might get affected by one particular event. And in that case, if you wanted to see the effect of that event, we have to select the certain companies. Obviously, we cannot take all the companies, all the firms, all the sector. So we have to select certain firms from that the group of that particular firms, sector of the firms. So in that case, what should be the selection criteria? On which basis we should select the certain firms? That we have to make the decision. However, there is no as such any rule which one we should choose. It depends on the objectivity of the researcher or the investigator, the purpose of the investigation, the kind of the event we have. For example, let us say if we wanted to examine the effect of the political event, so we could select the firms across the sectors, and then we can conduct the event study. So the selection criteria, there is no such objective selection criteria we have. It is a subjective, depending on the objective of the study, and depending on the subjectivity of the researcher, we select the firms or the sectors. Then next is calculation of the normal and abnormal return. Now remember, the return can be decomposed into the two part. One, this RIT, that is expected return RIT given the information of XT, where this eta IT is the error term. So this expected return, this means that this the return of a particular asset or the firm given all the information up to time t, and eta IT is the return unexpected return of asset I or the firm I at time period t. So this unexpected return is basically what we call the abnormal return in case of event study. So the idea behind this, or the logic or the reason behind this, is that this part is due to some abnormal event that is the responsible for this fluctuation into the average return or the expected return. So how we do calculate this abnormal return? If we take from this formula, we can write this eta IT is equal to RIT minus expectation of RIT given the information up to time t. So this eta IT, what we call is abnormal return. Then the question comes, how we calculate the normal return? See, this normal return is basically a benchmark, as we have discussed, against which we have to judge the impact of an event on the return. Now, what are the specifications we should do for the expected return? How we will calculate that? We calculate that from the estimation window which we have discussed earlier. Then there are the certain methods we have to calculate this normal return. So this could be categorized into the two parts. One, the statistical models or the economic model. In a statistical model, basically we derive the returns purely from the statistical assumption about the behavior of the returns, where we do believe that returns follow a certain kind of behavior, and following that behavior we try to expect, or we try to get the normal return. And in that category we have the two kind, where we have the constant mean return model or the market model. In economic model, where we put the certain restriction on the statistical model, and those restrictions is derived from the certain economic theory. So in the next lecture we will discuss what is the constant mean return model, what is the market model, and how we derive the normal return using these two different approaches. Then we will also discuss how we calculate the abnormal return and how we formulate the statistical method to examine the significance of those abnormal returns. So the abnormal return is the difference between this actual return and the expected return. So this expected return is basically known as the normal return. So what is the normal return? A benchmark against which we have to judge the impact of the event on the return. So basically if the event occurs, so we assume that there might be some change into the return. So how we can say there is the change? So to have that, we have to have the benchmark. So that benchmark return is known as the normal return. So that is basically nothing but we get from the estimation window using the expectation of that. Now how to get the expectation of that return? So there are the various approaches we have, different methods we have to get that normal return. Broadly we can categorize into two. One is statistical method, another is the economic model. So in statistical methods, basically we derive the normal return, assuming that the particular return follow a statistical behavior, and we use that statistical behavior to predict the normal return of that particular prices or asset prices. And based on that, we have the two types approach. One, the constant mean return model. Second, the market model. So Here the assumption is that asset price follows a particular statistical pattern, statistical behavior. If that is the case, then using this statistical behavior, we try to find out the normal return. So we get the expected value, and that expectation is based on this particular statistical behavior. And how we get that? There are the two approach. One, the constant mean return model, and the market model. On the other hand, this economic model is basically the restricted statistical model. So we put certain restrictions on the statistical model, and once we use that model after putting the restriction, so that is known as the economic model. Why we call economic model? Because those restrictions which we are putting on the statistical model, we derive from the economic theory. For example, the capital asset pricing model is nothing but an economic model, where we put the restriction on the statistical model, and those restrictions we derive from the theory. However, the commonly we use the statistical model. Now, the first approach of the statistical model, that is the constant mean return model. Here what we assuming, for each asset I, the constant mean return model assumes that the asset returns could be given by this particular approach, where the expected return of this is nothing but mu, that is a constant. And we assume that the variance, this eta it, follows a normal distribution with mean 0 and variance sigma square eta it. So the constant mean return model, actually we assume that expected return or the normal return is equal to mu, a constant. That's why it is called constant mean return model. On the other hand, the second approach is the market model, which is the most popular model to be used into the event study analysis. In this case, what we assume that the asset I is given as, can be given as like this, where now this expected return is equal to alpha I plus beta I RMT, where again eta it follows a normal distribution with mean 0 and variance sigma square. So here this expected return is equal to now alpha I beta I RMT, where, or we can write it like this here, alpha I beta I RMT. So we can write it here that RIT is equal to alpha I plus beta I RMT and eta IT. So here in this model, this RMT is the nothing return on the market portfolio. Now what is the market portfolio? Taking consideration of all the asset into the market, making it as a portfolio, however, which is quite unreasonable into the real world. Therefore, often we take a broad based stock indices and use it as a representative of the market portfolio. For example, BSE 100 or Sensex 30. So those, or Nifty 50. So those are treated as the market portfolio, which is a broad based index basically. Now, in this case, if this beta I is equal to 0, so what we have the constant mean return model. In that case, what will happen? We have RIT is equal to alpha I plus eta IT. So this is alpha I is nothing but now expected return of RIT given information XT, which is nothing in constant market mean model we assume as a mu. So therefore, when beta I is equal to 0, we go back to the constant mean return model. Now this market model has improvement compared to the constant mean return model, because it captures the effect from this also. So this market model improves, however, that improvement will depend on what is the IR square. So you might recall from the previous classes on the linear regression equation model, this R square is nothing but the correlation coefficient, or we can say coefficient, and it how good is we have fit. So that is the measure, one of the measure is R square. So higher the R square, that means better the market model we have. Lower the R square, that means weaker the market model we have. There are the other models. For example, we have talked about the CAPM, capital asset pricing model, where the structure is here like this, where RFT is basically nothing but the risk-free rate. Now, apart from this, the size or other characteristics of the firms could be included into this particular regression equation, and it could be treated as the regression with the expected return during the event window being calculated in the similar fashion. Only thing, we will have more regression equations. So in general, that is known as the factor models. For example, Fama and French 3-factor model, or we could include more than 3 factors. Then another approach is the control portfolio approach. Basically, in control portfolio approach, what we do, if we, let us say, we wanted to examine the impact of an event on the asset I, which belongs to a particular firm, let us say firm 1, then we find the similar firms. Now, this similarity characteristics could be on the capital, it could be on the size of the firm, it could be based on the beta, or it could be under the similar industry. Any criteria we can use to find out the similar firms which might not have affected by that particular event, and then we make it a portfolio. Then we calculate the return of this portfolio, and this return we treat it as the normal return. So this approach is known as the control portfolio. So these are the certain methods we have discussed here through which we calculate the normal return. So once we calculate the normal return, then we have to find out the abnormal return. So abnormal return is nothing but the deviation of the actual return from the expected return, or what we can say in this particular process, the terminology we use is the normal return. So here, for example, ARIT, so this is the actual return of asset I at time t, and this is the abnormal return of asset I at time t, and this is the expected return of asset I at time t. So the difference is known as the abnormal return here. Now, this return we have calculated, abnormal return ARIT, at particular time t. But it is not necessary that the return will be similar at every day in the event window. So if that is not the case, then what we use, we try to take the average over the particular event window. That what we know as the cumulative abnormal return. For example, the CAR, that is the cumulative abnormal returns of asset I for the event window T1 to T2. So we take the average of that particular window, we take the aggregate summation of that particular window, and that is known as the cumulative abnormal returns. Then are the certain other abnormal returns we can calculate. So in the next class we will be discussing about those abnormal returns. Then we will also discussing how we can test the significance of those abnormal returns. Thank you. See you in the next class.